Good afternoon, everybody, and thank you very much for joining us here today. We're going to talk about the changing travel trends, our capital flows, and what really is new in the market. I'm going to show you today some key data on the wellness economy at large, and subsequently the panel here under its direction will discuss different acquisitions and different thoughts about how the market is moving. GOCO Hospital is a dedicated company to the wellness economy, so I'm just going to talk about data related to this and some of the dynamics in the marketplace. If you want to understand the future, we have to understand the past. I think many of us are not familiar with the dynamics of the wellness economy because in our hotel schools, that's not what we learned. And if you look at the future, the wellness economy is a multi-trillion-dollar industry, has really a substantial impact on how people travel, and terms like rejuvenation, recuperation, detoxification is very much on the forefront of many people's mind. And what is significant, I think, here is that that Ayurveda and Chinese medicine, yoga, ancient practices from the Far East very much have penetrated and are leading the entire wellness trend towards the entire Western world. You can see people like Brian. It's a tech millionaire. Actually, he's a billionaire. He sold out to Google. He's 56 years old. His body is 28 years old, so that you can measure the age of your organs, as you know. And so he spends his money right now to look for living as long as he can. And we know that longevity is very much a key component of what many people want to do. They want to live as long and as good and be as healthy as long as they can. There are some skeptics. So Harvard Medical School, 50 years ago, 1980, started a study where they look at the modalities which make you live longer. And clearly healthy eating, healthy diet, exercise, community engagements, not to drink too much alcohol, were clearly indicative of living longer. And here you can see some data points. They're going up to 34 years. So that's a study from 1980. So it's a 50-year study, once concluded. And there's 3 different studies happening right now. So if we live a life according to certain rhythms and certain choices which we make in our lifestyle, we're simply going to live longer. Now, what has that related to it? It's related to an economy which is now more than 6 or 8% of global GDP. So it's a $5 trillion plus economy. It's supposed to be hitting next year at $7.5 trillion. So it's a substantial economy where different dynamics will be in play. And if you look at 2019, which for many years, for many of us in our industry, was a successful year, was a very stellar year. You can see today that most parts of the world have exceeded that, and what is really happening there, it's global wellness tourism and global real estate which are leading the way there. So there is a change clearly happening in that industry. And if you look at the resilience of the industry, you need to look at 2008 to 2010. The pants were down. The world had a substantial financial problem. It outperformed and it doubled during that time. So it went from $100 to $200 billion economy. The new data from 2023 is coming out, and it's substantially exceeding this. It comes out in 3 weeks from the Global Wellness Institute, so I don't want to take this away, but it's going to substantially exceeding what has happened in 2019. If you look at now purely on the spa industry is an amenity industry. Many hotels have spas and related fitness center. It has outperformed again 2019. But I think the Stanford Research Institute study is much more interesting. They looked at 100,000 hotel rooms over 5 years in 21 different countries. And clearly you can see longer stays, more spending, higher value for the respective hotel owner, the hotel company, and the developer. If you look at this data here, you can see that the total income for a respective hotel in 2019, 20, or 21, depending in which segment you are, is outperforming the wellness consumer is outperforming an ordinary hotel. Now, what is the classic resort and what is the wellness hotel? What are really the 3-4 key different indicators? One is a hotel always sells per person. A wellness hotel sells per person an ordinary hotel sells a room. So you have one-time a charge if you have 1.5, 1.6, 1.7 guest in your room, you charge per person. So there's a substantial different intake. The other one is the return guest ratios. There's somewhere between 10. 10 is Canyon Range, I can tell you this. Kamalaya, Shivasam in the Far East, 62%. Lanzerhof is in the 30s and 40s. So it depends where you are. The return guest ratio is substantial, coming back every year to the same. So the acquisition cost is a substantial lower one. The satisfaction of the guest who has emotionally bought into, living better, feeling rejuvenated is also different. So the connectivity to your guest from an emotional standpoint is very different. And who moves into the space right now? Dubai Holding on the right side, you can see Zero Dubai Holding, one and only, moving right now big time into this field. They have signed up 3 hotels already, and they have a budget to make the first 10 acquisition. If you look at Equinox, it's related. It's a New York developer who is in many locations in the United States. Is opening 11 hotels. They have opened the first one in New York City, the second one, I believe, Los Angeles and London. Again, you can see that there's a substantial growth there where larger players now moving in there. This is a picture, there's 3 people missing here, but the key here is that some of the key founders of our industry, Sternlicht, George Raphael, Capella, Horst Schulze, they are all involved in the wellness economy because the AMALA project in KSA, for some of you who are familiar with what's happening in KSA, it's a $22 billion destination integrative facility dedicated to wellness and wellness-related lifestyle forms. The smallest spa, the smallest wellness facility in AMLA is 4,000 square meters. So dedicated to this, and you can see some of the biggest players in the industry are really on the forefront there. So if you're not part of that yet, we may want to consider to learn a bit more about that industry. On the left side, you can see the well-being standards and how many more of those standards are implemented and followed. And well-being standards is just one certification to look at the well-being of a property and what it inculcates in order to give you a better sense of space and sense of feeling. Has over, I think, 2,500 applications there in 2023. And if you look at the wellness economy, in terms of real estate, it has also outperformed other players there. In closing here, just briefly, a couple of projects which are totally wellness-centric. On the left side, you see a project, is Forestias, it's the biggest investor in hospitality in Thailand. It's a $4.5 billion project. It is to a large extent sold out, and you can see what it has done there. And if you look on the right side, that's a $400 million project, Triananda, that's in Phuket. That's the first wellness community which comes up in Phuket. If you look a bit around the globe, you can see a couple of examples in the United States, and you see a percentage behind there. This is the premium people get for dedicated wellness real estate. So this is statistical data. That's not data we got from anybody else than from the developers itself. We are involved in 2 of those, so we can see what kind of premiums can be achieved, and we all want to, of course, achieve premiums in our industry. Little side promotion, we bought this in 2015, and I don't show you, this is the America's biggest hot spring resort. Whoops, I show you to show you this, how Instagram savvy and social media savvy today consumers are. You see some of the biggest hotels in Beverly Hills, in Laguna Niguel, Four Seasons, Ritz-Carlton, and things like that, Rosewood, and you can see our wellness resort there. We have more than double the amount of social media impressions and followers there, and we are generating from a pure EBITDA more than any of the hotels you see here. More EBITDA than any of the hotels you see here. In closing, this will be 3 projects which we have just acquired. They're going to be ahead of the market. We own them. One is a small living hotel, one is a former Meridian hotel, and one was a historic hotel in Switzerland which gets rebuilt. We're going to demonstrate their cutting-edge, next-generation modalities where the travel dollar and the wellness dollar are going to merge. So what's the take here? What's the net of this? There's a resilience industry because even during the biggest financial crisis, it performed rather well, or it doubled actually in total revenue. There's a lot of spending happening there, substantial higher spending from wellness consumers versus ordinary consumers, and it's surpassing the industry in terms of growth and what's happening there in the future. We're going to take questions, answers afterwards, and I think Ed and the panel will now come and start.
Thank you very, very much. That was a super interesting presentation. And I think a great example of how concepts and experiences pioneered in Asia are shaping the way that we travel over here. And sort of sets a bit of a scene, and we will, I think, come back to how the two concepts link, but then sets the scene a little bit for what we're going to talk about with the panel now, which is capital flows from Asia into Europe, and how Asian capital is shaping the nature of deals over here in EMEA. I'd like to invite my panel up onto the stage. We have to my immediate left, if you would, Camille Yazbek, who is Global Chief Development Officer, Premium, Midscale and Economy at Accor. Sabine Schaefer, Managing Partner of Pro Invest Group, and David Ling, Head of Hospitality Investment at CDL. To introduce myself very quickly, I'm Ed Fitch. I'm a partner in Cushman & Wakefield's EMEA hospitality team. I'm head of hospitality for the UK, but I spent a few years of my life based out in Singapore. Good to see some ex-colleagues from that era in the room. And I continue to act as a conduit for Asian capital for our clients, bringing Asian capital to our European deals. To give my fellow panelists a chance to introduce themselves, just start with you, Camille. Accor now, but your background, I think, in private equity gives you a slightly different slant on matters. Maybe you could expand on how your previous experience shapes your role within Accor. And tell us a little bit about what opportunities you see for Asian owners to travel with you over here and how you help facilitate that.
Sure, thank you. Good morning, everyone, or actually it's good afternoon now. I don't know about you, I feel very rejuvenated after this, right? But I'm definitely not that guy who doesn't drink and eat and all of that. So I need to improve, right?
You're dead man walking, aren't we?
Dead man walking. So thank you for having me today. So I previously to joining Accor, I was with private equity for around 7 to 8 years. We both improved and sold around 65 plus hotels. We created our own brands, but out of the half of the portfolio and the stock was actually part of Accor brands. And that was great for us because one of the key things was the focus of Accor on its ownership and understanding the owners, the cost of capital, the investment criteria, the return on equity. And that was very, very powerful for us, and it was a great deal when we exited most of the hotels. And then I joined the dark side, which is the good side now, especially in 2020. And I head up globally an amazing team of developers throughout the world. And basically, we have today 45 plus brands. And as you might have seen in the last year, we have within Accor, we have split the group into two. One is purely focused on premium mid-scale economy, and the other one is purely focused more of the management part, which is the luxury and the lifestyle. So two divisions, one heart, and that's the key point for us because we are really even more focusing on our owners, on the brands that deliver the returns for the owners. And just to finish, we have around 5,500 hotels globally, around 800,000 keys, and more than 200,000 in the pipeline. So we'll hit the 1 million keys next 2 to 3 years, out of which 90% is the premium mid-scale economy, because this is where you get the most of the development, and 80 to 90% of the future developments coming also from that, because the rest is more niche and focused. So from an Asian perspective, so Asia, we have had one of the best years ever last year in signings and openings and development. Our brands chime with the Asian community, and Yes?
Yeah.
Absolutely. There you go. Here we go. And great brands that have great legacy over there, from Pullman, Movenpick, Swiss Hotels, all the way to Novotel and Tribe and many other things with yourself, especially in Pacific also, and basically and the IBIS family. So the key question is Asian investors more and more interested today in Europe? Is the focus coming to Europe? Absolutely. So 2023 was one of the worst years in transactions globally. Not only in hotels, but also in offices, so 60% less office deals. Institutional, I would say, anything that has to do with residential and student and logistics, you just can't get the returns that you used to have. However, hotels in 2023 was only, and I say only between brackets, minus 18% globally. And the reason why is because hotels as an asset class is absolutely brilliant to bring the returns more and more to the investor. And the reason why is obviously you have price elasticity, you take more risk, but you still get these big returns. And obviously, more in Europe, one of the key things was you couldn't really get a lot of debt, and the interest rate is expensive. But the year has started really well. You can see on the news how things are moving, and we can see a lot of institutional capital, but also private equity and family offices really focusing on Europe. And I believe 2024 will be a great year for Europe, coming back.
I am personally delighted to hear that. Sabine, is that something that you would agree with? I mean, you have European and Asian platforms. How hard are they pressing you for Europe, or indeed are your European clients wanting to go the other way?
Sure, that, as you're rightly pointing out, is actually kind of it's a mixture of both, right? And I think what we see at the moment, so we have quite an established platform now in Asia, in Australasia, where we not just develop but also operate, and we work indeed with people like yourselves, Camille, and some of the other bigger brand owners as the I guess trusted franchisee, which obviously helps. We have our own brands as well for some of the kind of second-tier locations. So, but yeah, I think overall we see demand coming from Asia into Europe, in particular for assets that, let's say, just would not have been on the market for the last 15 years, right? Or at least since the GFC, yeah. Right? So the ability to acquire in top location assets that would otherwise never have come available is something that I believe catches a lot of kind of interest among some of the Asian investor base, absolutely. And then also vice versa, if you look at some of the kind of European investors, and for us, to be fair, by now it's about 80% of our investors are institutional. For them, the opportunity in Asia, the growth story in Asia, is something that just is indeed very attractive. So hence, yes, to your point, there is obviously demand from the European investor base to diversify somewhat into, an ever-growing Asia, which just has a population growth and everything else that, where Europe just can't unfortunately compare with. On the flip side, from an Asian side, having some level of diversification into Europe, whereby you can acquire assets at arguably attractive price ranges now, or at least get access to assets that otherwise you would have never had an exposure to or ability to get exposure to, is something where, where we see indeed a lot of interest from our investor base.
Super. And David, is that something that resonates when you are an embodiment, I suppose, of Asian capital moving into Europe this year with the acquisition that's been a big splash, the Hilton Opera in Paris. And what maybe you could tell us a little bit about what attracted you to that asset, but perhaps first before we do that, a bit of explanation of CDL. We all know CDL, global mammoth, but within CDL you have a hospitality REIT, you have Millennium Copthorne, you have the mothership. How do those buckets of capital, if you like, differ in their underwriting, their approach, and why did Opera end up where it did?
Thank you. We started investing in hospitality sector over 30 years ago, and including Europe. So Europe is not new to us completely. So we've learned. So we're global. We're in Asia. We're in Europe as well as in US as well. So like to say 40% in Asia, 30% in Europe, and 30% in the US. So again, we kind of learn our way around. And I was just talking to some of my colleagues. I've been in IHIF Berlin for over 10 years. And it's fascinating that for the first time I came in a day earlier and soaked in Berlin on Sunday. That was the best decision for me. Again, So it's not new, but rhyme with what Sabine mentioned earlier is that I see this as a window of opportunity as well. And really, what is it similar to like 2012, 13, 14? It's right after GFC. So now it's really just after COVID. So that's behind us now. So this is a window opportunity for us to come in and acquire and be a bit more proactive. I like to see us that because we've had 30 years of, if you call it tuition or learning curve, we want to be ahead of the game if we can. For instance, one example was in Korea last year. The market has been really lackluster since 2017, 18, 19. It was oversupply, hotels not doing well, things are coming down even before pandemic. And then 2022, 2023 comes, we saw that the market, again, hotels in Korea are simply for conversion to office. If you look at a hotel, they said, oh, wow, great, I got plans to convert to office. But then we're the first one to come in and say, we're buying hotel for the sake of hotel. And that kind of woken up the whole Korean market and said, oh, hang on, that's actually a good sign for the hospitality industry. And likewise for us, I remember 2014, I came to Berlin. I was looking at the Sofitel over in the other side in Gandemer area, and the yield was 6.5%. And I know we were not the earliest at that point in time. I wish I could have been in there on 2012, 13. I could have got 7%. But that's really 6.5 cap. So I went back to Singapore and said, look, guys, I think this is the time because my gut feel is very soon the yield is going to be 5%. And I map it out and say 3 years later it's 5%. But clearly, then we quickly moved into Munich when we bought the Camille Pullman in Munich. At 6 cap, and not waiting for 3 years. In fact, within a year, that's when the yield start crashing down below 5. And then when we were bidding for your competitor, the Hilton over in the big Hilton hotel, we were hoping to get 5%, but the bids came in at 4% even. So I felt that, well, sorry guys, that's the time when I don't want to be aggressive anymore. So that's when we say that, well, let's be disciplined and not get into it. So again, it's for us, we've learned our lessons, so we want to be first movers if we can. We can never get it right completely, but Paris still is one example whereby, not the earliest, but again, we felt that the market is right.
And taking a step back, so fundamentally, what is it that attracts you to Asia? You've got a lot of potential. You could be anywhere. You could be in Sydney. You could be in Singapore. What is it that and maybe things that you're seeing from your estate here in Europe already? What are from a consumer perspective, traveller perspective, what is it you like about the European markets?
Well, it's really a very, well-established markets. You talk about London, Paris, Rome, Munich, the big cities. We don't have anything in Barcelona yet. That's one area that we love to be in there. So these are really, if you look into the history over the years, these markets deliver in terms of performance, but also in terms of asset value. If you look at 30 years ago when we bought into London, really, I think the asset values are tripled, quadrupled even. So really, again, Paris is the same thesis as well. If we buy to hold long term, it won't be wrong. Yeah.
Got you. And before we sort of drill down into the places to allocate capital, we talk a little bit about the Asian traveller. Camille, what are you seeing in terms of your guests? What is the Asian traveller looking for? Are they finding the experiences they want in Europe? Which of your brands and concepts is proving popular from the traveller's point of view?
Sure. So, in general, in Europe, 80% of the travel is intra-European. But the key point is you can look at STRs and RevPARs and you think we are back to the same numbers of 2019, but not really. Because on a real scenario of average rates, including all the inflation, if you take it into consideration, we're actually still way beyond that really point where we were. And that difference of 20 to 30% was coming from the US traveler, from the Asian traveler, etc. So the key point now, I absolutely believe, that's why things are moving, although the debt markets are not yet, but it will come. I think it's the best time for you to really, go into Europe when you get the right yield. And it will compress, but also because of the EBITDA and the improvement to the bottom line. So you have two things. One is the compression of the rate, of the cap rate, which is going to happen, I believe, not straight, but within the next couple of years. But most importantly, I believe that the performance of the hotels will become much better, especially when the Asian travelers, the US has come back and is coming back, but the Asian travelers are moving and coming. Are we ready? Are we ready for the Chinese travelers? Not really, but we are ready because we know we need them and we know we want them. So you can see, for example, in Singapore, there's so many Chinese going there and the average rates have gone up like no tomorrow. Why? Because of the visa. Everything is open. And today, this year, France, China relationships, I think it's the 60th year of great relationship with China. And it's very important. We can see that happening. We can see the Chinese travelers. We can see also the Olympic Games, which we are one of the highest sponsors within France. So that was the long answer. The short answer is yes, it will come, and they're coming from Asia, and we need to be ready.
And maybe just to add as well something about, why in addition to the cap rate movement that we'll see, because everybody would agree that hopefully interest rate rises are off the table for the time being at least. It will be higher for longer, but it's not going to go up anymore further. I think there is something else really, which is the weight of capital that asset allocators started to put into hospitality. And I think that that's really something that's new as well. So in my career, the last 20 years, I never saw this. I mean, 5 years ago, you would have said hotel is the preferred asset class compared to offices. People would have thrown you out of the, off stage basically, right? So I think there's a change of mind. And I believe also that as an asset class, because it happens to be an operation intense asset class, you can actually create alpha. If you know what you're doing, if you have a good operator, you can create alpha. You can actually hedge yourself to some level against the inflation or inflationary pressures that are out there. And that's very much to Camille's point, right? I think net, we are ahead of where we used to be in 2019. And by all means, if you look at the forecast for the summer, in particular in Europe, I think we continue to see the same. While energy prices apparently are starting to be under control, everything else starts to come down. Still from an ADR and now the upcoming occupancy level, I think hotels again are going to have a fantastic performance this summer in Europe. And I think everybody would agree with that. So again, summarizing, yes, there is the cap rate compression that's there simply because of structural interest rate kind of environment. Yes, there is additional demand coming from travelers because, by the way, hotels have been around for hundreds of years, right? Yeah. And I know in the middle of COVID, when I said people, it's time to buy now, right? In particular, it's an asset class where you can buy from a single asset owner, that is not institutional, maybe whatever kind of an owner operator who just has no succession in place or whatever it may be. You get some good opportunities, right? Think about other asset classes where they're all institutionalized, like data centers. Fantastic asset class, but it's all all institutionalized. So where's the juice when BlackRock sells to Blackstone or the other way around? Yep. Hotels still give you, if you know what you're doing, you can find the opportunity. And by the way, it's a massive asset class, right? I mean, we looked at some 6.5 billion of deal flow last year. I invite you to tell me where you can find 6.5 billion of deal flow in some of the other kind of areas that people now like to go into. It's large, right? And not every deal is for us, but you find what you're looking for.
It's a fair point. But the landscape is vast. Is the sweet spot for Asian capital all that large? And David, forgive me, but Paris is something of a no-brainer. Yeah. And look at your existing holdings. What specific markets will you be looking at? Are they just gateway cities? And again, to bring you back to the structure of CDL, how does that differ for you personally or the REIT? How far outside of that gateway will you go?
Where we wanted to actually to have the ability to tap into different market segments. Of course, the REIT is, I've worked for the REIT before, and we've been quite acquisitive. In fact, bought into the UK markets as well, not just in London, but also Cambridge,
gone to Cambridge, Manchester,
Manchester, and so on. That also, went into Munich and Florence and places like that. So that's really, but the REITs struggles a little bit at the moment because of the high interest rates environment. Then, of course, we got to bring in a parent company to say, okay, let's, acquire these properties and possibly sometime down the road, some of our assets may be pumped into the REIT platform, for instance. That's another way. And we've operated on many different models. The other buckets, if we mention, is actually Millennium and Copthorne. Was formerly listed on the London Stock Exchange. So 2019, we took it private. So, why did we take it private? Because CDL grew up from real estate. So we know there's tremendous real estate to unlock in hospitality assets. For instance, just a quick example, we bought the Seoul Hilton Hotel in Seoul back in 1999 for $250 million US, thereabout. And of course, in 2022, 2023, the valuation was, call it 250 million. Buyer walked in and paid 900 over million. So, hey, why not? If someone came in with that sort of money. So it's real estate. And really in London, if you were to look at a property in, again, High Street Kensington, Knightsbridge, Gloucester, and Chelsea Harbour as well, these are big plots of land. And once my chairman asked me, so what do you think about the valuation? I knew it was a trick question. I said, look, how do you want me to answer? Because I was back in 2019. They said, what do you think about the valuation that just came in? I said, do you want me to look at it from a hotel price point or is it real estate price point of view? If it's real estate, forget about all these, about the valuation. Because you got 2 acres of land in High Street Kensington, freehold. What do you think it's worth? So thereafter, he won't ask me any more of these questions. So he knew I read his mind as to why we took it private. Korea is one classic example of what it is. So there's a lot of this sort of real estate. Paris is the same as well. Right in the smack of city center, freehold island site. If it's not a hotel, it's an office building in the future. And at the same time, we get a really good yield. So that's where we're coming from the hotel. And as Sabine mentioned earlier on, after COVID, for the last 20 over years, hospitality is really just the poor cousin of the office industry. It's always like, you guys are number, maybe just slightly better than industrial buildings, properties. So now, actually, wow, okay, given better yields, really good returns. Actually, exactly if you know what we're doing, then that's the key. So Europe-wise, we're not just investing in hospitality, we're also going into student housing, also into build-to-rent. We're actually constructing in Liverpool, Manchester, and Birmingham as well, big projects. Yeah.
Actually, there's a bit of a blurred line, isn't it, between hospitality and living now? So for us as well, it's the kind of co-living space that we are at the moment kind of, really making a number of projects in that space, which is close to the extended stay. And yet, as we discussed before, it really also helps to solve a residential issue that a number of countries do hold, because there's just not a lot of resi stock out there. So, yeah.
Would that suggest, so that as long as the real estate's good, the Asian money will follow it? I mean, how far outside of those core locations will people go? Would you rather do a hotel in London? If I can't, well, I'll do student, I'll do co-living. I'm not going to go to Liverpool. I've got to be, if I'm in France, I'm looking at Paris, I'm not going to go to Marseille. How far outside the kind of accepted sweet spot will this capital look at?
I think the first port of call will always be the kind of main capital cities in Europe, because obviously everybody tends to find them as well on the map. But then that's, I guess, when people are starting to work with, parties such as ourselves, so people who have the local knowledge, boots on the ground, have been active in an industry, can help on the development front, can get the approvals done, can renovate your asset, can do the operations. So that's all the kind of stuff, and then the asset management. So that's all the structuring and what have you. So that's kind of the way why I guess a number of parties that we are working with and for tend to kind of also then look outside of just the main capital cities and look a little bit more into what are the local demand drivers, what is the outlook, and yes, and to your point, we have 2 projects now where we actually are converting a hotel into a kind of more living area, just because the demand drivers or that particular asset has been there for the last 50 plus years in Switzerland, and went through various cycles of hospitality, and then just because the city moved, right? And so at the moment, just from a high and best use perspective, it is no longer a hotel, but it's going to be a living area. And to your point, the value from a resi perspective is significantly higher. So that's what we try to unlock for the investors.
So just to add on this, because you guys have different investment criteria, different sources of capital, different return criteria, I would say. So it all depends on this. So we have the privilege in Accor to do deals globally with so many types of investors. So whether it's private equity, family office, core plus, high net worth, etc. So what we are seeing, especially in Europe, because the point is Asia to Europe, what we're seeing is because interest rates are so high, because debt is not readily available, what we've done is created an environment or a deal for owners to make sure that they are investing in the hotel space and still getting their returns. As a matter of example, you mentioned conversions very much. So, and this is not only in AAA locations or AA locations or key cities. It's very important that when we do things, we look at it on a mixed-use basis. So we're doing a conversion with one hotel brand. We're adding what we call the living part, so a part of extended stay sometimes. So if we talk about a Pullman living also, so 200 keys, 20 or 50 of those is living. So that's the extended stay, diversifies the risk for the investor, gives you a base occupancy so you can add on the rates. And what is really becoming even more important is the branded residential. So we are doing branded residential, which is making much more returns for the investor because you get cash in advance and they reinvest in the property. Now, it depends which areas, but we're doing much more as we are becoming one of the largest, actually we are the largest outside the US in branded resi. But to continue on the complex, if you like, we have the F&B, and the F&B, we own 2 F&B companies, so you have Paris Society and other, and we bring the F&B concept from A to Z to the investor. And why? Because the F&B concepts are for the local community. So the more we do F&B for the local community and you attract the neighborhood, the more the international traveler will come. And that is a big advantage. And on top of it, we have wellness. So we've taken Emlyn from your team. And the global wellness, what we have seen is actually this is what we're integrating in our Swiss hotels, in Movenpix, in other, because it is the trend and it works really well. So when you put all of this together, and then you allow retail, you allow gyms, leisure, other things, student resi, branded resi, build to rent. So this complex together, they're getting debt from the bank because they can see diversified cash flows, and it compresses the cap rate for the owner. So that's the key sweet spot, and with you in a different way, and with yourself in a different way, and in others directly to the point. So all depends. But that's the key focus for us. And it's working really well. So last year we did sign 60,000 keys. Globally,
well, and
which is good, but with this,
up on is coming back to deals and real capital flow is we've seen a steady trickle, I think, of Asian investment. David, you're responsible for a big part of that, but we all know CDL. I think the others are a little bit more unusual. Sun Venture bought in Allgate. We've seen Sono Hospitality from Korea by the Dame des Arts in Paris. So we're seeing a trickle, and some of those are new entrants. But of course, compare that to 2016 when you sold the Jupiter portfolio to Singer. We saw Fraser's buying among us, Hotel du Vin.
Yeah.
M&L were buying up in Aberdeen. You know, the range is not quite there. You know, are there new entrants beyond, may I say, the usual suspects that Camille, you're seeing from your partners in Asia looking to come to Europe? Are there people that I won't have heard of? Are there new entrants, and what kind of capital are they? These family offices, big conglomerates, or are we likely to see a resurgence from those we know?
So I'm seeing more of the institutional, so the core plus, just like yourself, David, because I think it's an opportunity. And private equity are starting to move now, finally, especially in Q1 this year. There's some good deals that happen. And basically what's happening is some of them are either financing internally at 20%, and some of them are leaving the financing to be done in the next 2-3 years because they know it's going to move. And the other ones is family offices, whether they're representing the high net worth or directly the high net worth, because they're really, actually in Asia, it's very expensive. We continue to do it, but they are really focusing on Europe, and we need to do that. But one of the key points, just to mention, we did last year a very big deal in Japan. So 6,500 keys, Japan is 200 bips, okay? And 200 bips is very, very low, but the yields are very low. So the only way we were able to do it is really to think like an owner and put ourselves in their shoes. So the guys who bought it are private equity, so they need to do a return and exit in 5 years. But we also try to help to do a back-to-back deal with the REIT, because that's perfect. So they buy, we take the risk with them, they stabilize it, and they sell it to the REIT. But that's the key point. This is how we can move forward.
Sorry. Okay, I think the Asian capitals are coming back. In all fairness, I think perhaps the likes of I'm not sure Archer Capital is here, but through GIC and these are the ones. Again, the institutional money, they can see and read the market, and they see long term. So they are the first movers, if you were to say, and like us as well, we see things long term as well. So we're not investing, buy, fix, and sell. So our model is different. So again, to us is, in fact, now is a great time to come in, and I think it's good that I hope that GIC is seeing the same way as well. That's why they've gone into Spain. But the rest of a lot of the other investors from Asia, they are coming. I was on the call as well yesterday with another group from Indonesia. I said, hey, you guys, what are you looking? Is there anything that you like? I'll just let you know. While I felt that they already have investment in Germany. They said, well, office buildings and so on. But we said, look, hospitality space, since you're keen, I'll bring it in as well. So
I think it's also, I guess, the reason why we see a bit more transaction now is because compared to last year, people are starting as well to realize that the kind of huge spread between bid and ask is kind of starting to narrow down. People are a bit more realistic as well in Europe from a price expectation perspective. And as a result of that, you can actually make, the point is really, without taking an awful lot of risk, you can make, easily core plus returns, right? Without over leveraging either. So that's certainly something that is a unique, that wasn't the case. And also, by the way, those who have been trying to chase the 20% net IRRs in the hotel deal, waiting for, they have been kind of hanging high and dry because, it's true. You'd be surprised how many people told us, for the last 12 months, we need to see for hotels our minimum 18-20% net IRR after everything. So good luck to you. If you find that asset, my argument would be there must be intrinsic risk inside that I don't want to touch, right? But if you're looking for, mid-teen kind of, whatever, 12, 13%, that's something you can get on scale in Europe without taking too much risk. And I think that this is really where the sweet spot is currently, at least from our perspective.
Absolutely.
I'm going to just hold that thought because bid-ask spread is narrowing and investors' return requirements lowering. That's good news for me anyway. So I might just want to pause the conversation there. Bearing in mind that thought, David's point about Asian capital returning, and Camille, your success stories. Have we time, Captain, for a question maybe? Or two, maybe? I know we started a bit late, so does anyone from the floor would like to ask these fine people their experience? And we've got a couple of minutes.
Seems like we said it all.
Yeah.
Nicely done. Nicely done.
I'm sorry. Please.
There's a microphone on its way, and if you wouldn't mind
Thank
telling us who you are.
Thanks. First of all, thank you so much for the informative session, and I think you guys managed to capture all everything. But my question is on the trends part of this, because you talked about office space going down, and we talked about living. Have you ever thought about combining a hotel and an office together and creating a hybrid kind of a model? And do you see that there's a trend for that? And are the big brands like Accor, do you have plans to kind of invest in these kind of new trends?
Shall I? You start.
I can tell you not from a branding perspective as such, but yes, of course. I mean, the fact is that the majority of hotels are now starting to figuring out what to do with their great room areas downstairs. And a lot of that kind of ends up being kind of flex office desks, right? Or kind of people, and there's even now companies in the tech industry kind of focusing on bringing people in, because it's a great way. If you think about it, the downstairs areas from a hotel guest perspective, you come into the hotel normally late afternoon, you stay there evening, overnight, and then sometimes in the morning you leave, while the person who's working probably comes in the morning just at about 9 o'clock when kind of the hotel guest left, and probably is going to leave the hotel premises again at about 5 o'clock. So there is a natural fit there that more and more people are trying to explore. There are some, on the branding side, I'll leave Camille to talk about it. I don't think there's a specific brand yet. I do believe in the old days, GOCO tried to create something similar, right, with the idea of having your kind of hotel upstairs and kind of a bit more like a communal working space area downstairs. But as a theme and being a bit brand agnostic, yes, it's certainly something that a lot of hotel owners trying to figure out how to maximize the return on their GFA space.
To answer your question, yes, we do. And we have a co-working company called Wojo, and we have other co-working companies within Hoxton and within the whole Ennismore. And actually, this is the future. Especially, it depends on the location where you are, but that's why the F&B and the whole area is so important, because you attract all the customers there. They're all thinking, eating, drinking, working alike, etc. If you're talking about pure office, like you're taking a lease on the office, we also do that with the some of the Ennismore and the co-working, and also with Wojo and everything else. But also what we are doing is within mixed uses, we also can leave an office side of it on its own if the owner wants, because they can also diversify the risk and have it and decrease and increase the EBITDA per square foot. That's the objective at the end of the day. So there you go.
Okay. Anything else from the floor? Either for us or for Ingo, coming back to the wellness concept. Please, if you don't mind, the microphone is on its way, and then we'll...
My question's for Ingo. So a lot of the projects you showed us were luxury projects, but are you seeing in the future, do you think that's going to change more to the premium mid-scale segments?
Yes. Our biggest project, our biggest asset, it's a $180 million asset. It's in California. We have 500 people a day there. It's a hot spring resort. It's America's oldest hot spring resort. We're turning over just in treatments and admission and related $40 million there. That is more than many hotels generate. And that's purely driven by an accessible customer. And if you want to give him a rating, it's somewhere between a 3 and a 4.5 star customer, because he spends an average of around $250, $280 with us.
Sorry, just if you don't mind interrupting. I was just digesting what earlier on saying. Also need to be a little bit cautious, because working patterns has changed around the world. And what we've experienced, I mean, WeWorks is an example, and in some parts of the world actually not doing very well. So got to be a bit cautious about that as well. I mean, we continue to invest in offices like St. Catherine's that we bought last year. But at the same time, that elements as well, because nowadays, you know, you can do a lot of meetings and so on just over the internet. So also a note of caution as well as to co-living, you know, co-working space is a good thing, because you set up an office in a new city or new environment. You don't want to be committed to 5 years, 10 years rent. You start with co-working space and offices and so on. So that bit as well, but again, just be a little bit cautious as well. Some of those, co-working space are evolving and changing as well. So, yeah.
Well, I think we've overrun. We're at 1 o'clock, and I'm sure there's lunch to go to, if not other sessions. So I'd just like to thank my fine panelists, Ingo, for the wonderful presentation. David, Sabine, Camille, thank you ever so much for taking part today. Really appreciate your input. And thank you to everyone in the room for coming along to listen to us. Really appreciate that as well. Wish you a very successful rest of the conference.
Thank you.
Thank you.
Thank you, guys.